Welcome everyone to the Multifamily Investing Community Meetup. I'm Andy Bentz. I'm your host of this community. I am the principal at Blue Horizon Investments. We help busy people invest in real estate through syndication. Today we have a special guest, David Monroe, CCIM. I got some before I introduce David, I want to just go over some housekeeping. A few questions for David. I'll walk through a few questions with David, just to kind of introduce him. And then he will be presenting on calculating current multifamily demand in your market. So that will be his presentation today. If you have questions, ask them along the way. Put them in the chat first, and then I'll pull them up and ask along the way. But I've worked a lot with David, and he's very flexible and he's open to questions. So please ask them. There's no dumb questions. And then at the end of when this meetup concludes, you'll get a survey from Meetup, and I'd ask you give your honest feedback. If you could take the survey, that just helps me and my group and helps the group grow. So with that, I'd like to introduce Dave Monroe. Hold on one second. Dave Monroe, CCIM. He is a multifamily investor and strategic partner and specializes in market analysis, demand, supply analysis, market cycles, feasibility analysis, and teaches that specialty as a CCIM instructor. David also consults lending options, acquisitions, and disposition after-tax savings and strategies, and has the unique ability to connect syndicators, sponsors, key principals, and investors together to get the deal done. David was a United States Marine for 11 years, 4 months, 16 days, very specific. They instilled into his core values, honor, loyalty, integrity. His passion and focus are to build strategic partnerships with syndicators, sponsors, and key principals, and invest passively to build wealth for his family legacy. Dave has been a sponsor, JV partner, passive investor on multifamily syndications. He now is solely focused on being a strategic partner. And lastly, David owned a multifamily property management company and gained the education of a lifetime on how multifamily properties operate and what it takes to manage one of these assets. This made him a better investor, broker, consultant, and strategic partner. I want to say all that, and I met David through a conference, and I am a student of his. He runs a Mastermind group, so maybe he can talk a little bit about that a little bit later in the presentation. But I found it very valuable. With that, I appreciate you being here, David. I have a few questions. Let's jump right in.
Roger that.
So you are a CCIM. What exactly is a CCIM?
So a CCIM is a certified commercial investment member. And I'll tell you what it's not first. So if you identify as a capital raiser and you want to know if CCIM can help you as far as credibility is concerned, the answer is no. They do not teach you how to be a capital raiser at the CCIM Institute. If you are responsible for underwriting as a capital raiser, or you want to be able to underwrite, then yes, absolutely, CCIM can definitely help you. The Institute itself, we have a curriculum of 4 core courses. I teach one of those 4, which is the market analysis course. That's 102. Those 4 core courses are used as the curriculum at over 100, well, not over, at 136 major universities in this country as their Masters of Real Estate programs. So if you want to know if it's good curriculum, it's the best. They actually write the curriculum, the same curriculum that you take to get your designation, these universities are using in their Masters of Real Estate programs. It is an investment real estate organization, thus the I in investment member. And it's not easy to attain the designation. They are an affiliate of the National Association of Realtors, but only 60% of our community are brokers. The rest are syndicators, attorneys, lenders, appraisers, developers, CPAs, anything dealing with commercial investment properties, whether it's multifamily, hotel, industrial, retail, office, any investment, commercial real estate is welcomed at the CCIM Institute. So that is the Institute in a nutshell. It is by far the best education.
That's awesome. So how did you get started in real estate?
Well, that's a good question. In 2011, I was sitting in a hotel room in Marianna, Florida. I was transitioning. I was a helicopter mechanic in my former life. Myself and Julio were talking about this extensively, at least on the Marine Corps side of it. I continued that into the civilian world as an A&P and then as an IA, which is just licenses to work on aircraft. And I'm sitting in a hotel that I was moving from Orlando to either Marianna, Florida or Mobile, Alabama, depending on what position that I was going to get chosen for from the company I was moving with. It's December 28, 2011. I'm sitting in my hotel room and I thought to myself, Self, when are you going to be able to retire? If you want to retire, let's say at 55. And I got scared, really scared, because I only had about $50,000 in a 401k and not much in the bank. And I had sold a bunch of stuff that year, a boat, a plane I was building, a junior dragster, a bunch of go-karts. So we had a lot of cash. Plus I had a lot of overtime that year and made over 100 grand and very little in the bank. And so I started thinking, all right, what the hell do I need to do in order to build wealth faster so that I can retire at 55 if I want to? I was 42 at the time, and started Googling it, and real estate kept coming up. And so I just started researching that, found a program, an old Carlton Sheets program called Weekend Millionaire, and it just kind of snowballed from there.
Cool. That's awesome. So you talked about a little bit in your bio about creating a family legacy. Why is that important to you, and how do you see doing that through real estate?
Ooh, you want me to dig into my why? Oh, good question. So and not a lot of people have heard this, I'm not one of those that tells my sob story and then builds up into this great person. That's not me. So I only tell this story when I get asked the question. And when I was in high school, one of the things I did was, when I was 6 years old, I set a goal to be a Marine. I was going to be a Marine. I don't know who put it in my head. I don't know why at 6 that I set that goal, and I didn't realize I was setting a goal. I just wanted to be a Marine. And so my family over the years kept pushing me. You're going to be a Marine. You're going to be a Marine. Yes, I'm going to be a Marine. I wanted to be this big, bad, Marine grunt. That's what I wanted to do. And when I was in high school, I actually ended up homeless for a little while, almost all of my junior year. And so I had to bounce from friend to friend, living in backyards and tents. Sometimes, you can sleep on the floor in a sleeping bag in the room, and the parents had let me in. But for a long time, I was struggling to find somewhere to stay, but I continued to go to school. And I knew that if I did not graduate high school, because there's no waiver in the Marine Corps for a GED to get in, that I wouldn't be able to join the Marines. And since 6 years old, I've been telling myself I'm going to be a Marine. And so that goal kept me in school. So that's when you hear Napoleon Hill talking about a definite chief aim in Think and Grow Rich, that's how powerful a long-term goal can be. That I could have easily gone a different route, got on drugs like my brother did, done all kinds of different things and taken the easy way. But because I had instilled in my mind that I was going to be a Marine, hell or high water, that kept me in school, and I ended up graduating and becoming a Marine. So my why, or why I want to build that legacy wealth, is because if something ever happens to me, I want my family to be taken care of so they don't ever have to live the way I did when I was in high school.
That's great. So tell us a little bit about strategic partnership. What is that exactly?
So that is a term that I am working to get coined in the syndication world. You know, we have GPs, LPs, KPs, general partners, key principals, limited partners. So I am working to create the SP, the strategic partner. And really, there's already people doing it. They just don't call it strategic partnering, where you provide some kind of expertise. And that could be as little as boots on the ground, although there's nothing little about boots on the ground, to be able to become part of a syndication. So for me, it can be boots on the ground if it's local. I don't mind doing that. I'm actually doing that for one of our members in my strategic partnering community in a town that's an hour and a half away. Underwriting support, due diligence support, market analysis, feasibility analysis, demand supply analysis, capital raising, whatever that expertise is, then I can fill that role for some piece of the pie. Now, for me, and most people aren't going to be this way, but for me, I like to get a piece of the acquisition fee. It's already built into the deal. So when I'm invited into one of these things, they don't have to raise any additional capital. I'm not taking any part of the GP because that doesn't align with my legacy wealth building goals. And then I'm going to take 80% of the fee I make and I'm going to put it back in the deal as a limited partner where it does align with my goals. The only reason I bring 20% to the house is because I got to pay Uncle Sam when he comes to calling.
Gotcha.
I got it from being a broker and investing in deals as a broker. So I like to take half my commission and invest it. And I have no idea how the dogs got up here because I had the gate secured so they couldn't. One of them must have knocked it down. So sorry about the noise outside the door.
Those are Marine dogs.
Yeah, right. I wish.
So tell us a little bit about the Mastermind group that you run. Tell us the structure of that, because I found it when I was seeking out education and trying to learn about multifamily investing. I was looking for a way to do that, and honestly, I went to some of the bigger gurus, and I found that I didn't get the feel, or it didn't feel like a fit for me, and quite honestly, the expense was very high. So and I found your group and I joined it, and I felt like it was a good fit for me. Tell me a little bit about the group, or tell us a little bit about the group. What do you do? How is it structured, et cetera, et cetera?
So what I've done is I've put together a community that we are growing. There's quite a few people on this call that are actually part of it. And it starts with a 12-week intensive on some stuff you've heard before, but I'd say, and you tell me, Andy, probably 60 to 70% of it, it's stuff that's not being taught anywhere. And there's anywhere from an hour and a half to 2.5 hours per session, 12 weeks long. And we've got other things we do. We do weekly Q&A every Wednesday night. We do goal setting every Monday night. I allow people to reach out to me anytime they want just by scheduling on my calendar. There's no, structured, you can only contact me once a month deal, hide my phone number from everybody. Everybody's got my text. I mean, you're going to have my cell phone number here shortly when I pull my slides up. I'm very approachable, very personable. I am not a guru, and everybody in my community knows how I feel about gurus. And we're just a fun community that we're working towards building some syndications together. We've got a couple of KPs in the network already. We've got some people that are co-sponsors, some passive investors, and we got a bunch of new people that are just learning, and we're all supporting each other. It's a real good, tight-knit group. I was talking to a couple of people today that tell me how much they really enjoy being part of the group. And we're more of a family than we are a mentoring group.
I would completely agree with that. I think it is a family, and we just had a meetup where people came in from Alabama, from Arkansas, It was up in Chicago, quite a few people
Michigan.
from Michigan. Yep. So we came in from all over, and it was a great meetup, and it was great
Don't
to see
forget
people.
about Denver.
That's true. Yeah, that's right.
Andy, may I
So,
jump in a question?
yeah, sure.
David, I just wanted to understand better. So the mentoring group is different than the CCIM Institute that you were mentioning at the beginning?
That's correct. Yeah, completely separate.
And if you don't mind, you mentioned that there are 4 courses in that CCIM Institute. Market analysis is one of those. Just wondering what are the other 3 topics that they cover?
So 101 is financial analysis. So if you've ever taken a financial course in college, that's basically 101. Teaches you about time value of money, discounted cash flow, net present value, T-bars, all that kind of stuff.
Okay.
102 is market analysis. 103 is user decision analysis, meaning if I'm a user of a space, or I want to purchase a property and run my business in that property, and I'm the one that's in that property. I'm not a tenant. Well, I am a tenant, but I also own the building. So that's user decision analysis. A lot of leasing involved in that one. And the last one is investor decision analysis, which I like to say is 101 on steroids.
Michigan farmers make an
Okay, thank you.
Yes, sir.
next time on stateside.
Great.
The Meetup is
Can I ask everybody to mute if they're not speaking, just put yourself on mute. All right, perfect. All right, at this point, I'll turn it over so David can walk us through his presentation.
All right. So
You should be able to.
yeah, I've got to get set
No
up
problem.
here. Just give me a second. There it goes. Spinning my, whoa, I didn't want to do that. There we go. And back to this. Share. All right. Can you see my screen?
Yep, we can see it.
All right. How to calculate multifamily demand in your market. I did a survey a couple of weeks ago. Some of you that are in my network probably saw it, where I asked the question and gave 5 topics. Of these 5 topics, and emerging markets was one of those topics. What would you rank as being the #1 concern for you, and what would you want to learn about? Because I was going to create a course about it. And #1 was capital raising by a big margin, 42%. And #2 at 24% was emerging markets. So calculating multifamily demand in your market is definitely an interesting topic for most people. And interestingly enough, because I have I have 2 other webinars. One of them is on capital raising, and another one is on finding partners and investors through strategic partnering. And the one that gets asked to present the most is how to calculate multifamily demand in your market. So there's definitely a need out there for this and understanding it correctly. Okay, there's big difference between what a lot of people are teaching in the market and actually doing it correctly. So, well, we got to get the technology working here. Here we go. Today's objectives, or tonight's, depending on where you're located. If you're in California, it's still today. Understanding the current multifamily market cycle. We're going to go over a couple of examples of that. Where to find the data. So we need to know where to go to get information so that we can make decisions. How to calculate current multifamily demand. So we'll get into the math. Yes, there's some math involved. Sorry, folks. We have to go back to our school days and actually do a little bit of math. We don't have Excel to do it for us. We got to do it on our own. And then how I'm going to give you a high level, kind of a teaser on how to estimate future multifamily demand, because if I was to go through the entire economic base analysis from start to finish, we'd be here all night. So I'll give you a high level, kind of a teaser on how to predict the future. Okay. just a little about me, and Andy touched on this really well, so I'm going to go through this fairly quickly. I did put my contact information in the chat if you guys want to pull my contact information and my value proposition. I'm a multifamily investor and strategic partner. I'm a certified CCIM market analysis instructor. You can see my badge down here from the CCIM Institute that I have to wear whenever I am at events. I am the Florida CCIM VP of Education for this year and next year. I'm on the tech board for the next 3 years. I'm on the foundations board for the next 3 years. And the foundations board is the capital raising arm for all of our scholarships for CCIM and Julio. We have a veterans scholarship program. So when you get out in a year, you have to have a DD 214 to qualify. When you get out in a year, get a hold of me. I will definitely get you help on getting your CCIM education free. Cost me over 15 grand from start to finish. We will pay up to $20,000 for veterans to get their designation. Just something that we provide at the Institute. I'm a former syndicator. Now I am a strategic partner, and we talked about that already. And as Andy said, I used to own a property management company, and that was my MBA that I got. No better education in the world than owning a property management company. And I did learn that the only thing that has lower margins than restaurants are property management companies. So stop beating your property management companies over fees. You get what you pay for. If it's 20, 30 units, be happy to pay 10% because they'll do 10% of the job. If you want to pay 6%, you want to pay 7%, 8%, then they're only going to do 6%, 7%, 8% of the job. It's a lot of money to own a management company. So just take that for what it's worth. Understanding the current multifamily market cycle. How the heck do we do that? Ooh, bell curves. Yeah, we all hate bell curves, right? Well, I'm going to grab my little tool here. So let me come up to annotate and get my spotlight. So if we look here, we start in phase 1, we have phase 2, phase 3, phase 4. All right. So in phase 1, in the CCIM world and in the financial world and the economic world, we call it recovery, expansion, oversupply, or hypersupply, and recession. If you read some of the multifamily guru books, David Lindahl specifically, he'll call it buyer's market phase 1, seller's market phase 1, seller's market phase 2, buyer's market phase 2. Okay. So they got this all kind of discombobulated, but this is kind of what they're meaning. They want to try to confuse you a little bit. So in recovery, let's say right here, this point we'll say is 2000, coming out of 09, going into 10, we were sitting kind of down here at the bottom, and multifamily led the charge. We started trekking up a little bit. Okay, so as we go up, we've got negative rent growth. We've probably got pretty high vacancy. This is our long-term occupancy average or vacancy average, whether your cup's half full or half empty, either way. All right, so below this means you're higher vacancy than, say, the 20-year average of that market. So down here, we got high vacancy. We are probably still in rent decline, but stabilizing. Concessions, we're trying to lease up. As we continue up recovery, now rents are stabilized. Maybe they're growing a little bit, and occupancy is starting to increase. Vacancies obviously are decreasing. It's the inverse of occupancy. Concessions are starting to wave a little bit. And as we get towards the long-term average, we're starting to see some faster rent growth. Now our vacancies are really starting to tick down. And once we reach this little green point right here that says new development, I know it's kind of small, that means that our rents are now strong enough, high enough. Can look at this as our net operating income line. So as our rents are increasing, our NOI is increasing. And so once we get to this point, we can finally afford construction. Down here, there was a good chance where we had higher vacancy because there were just, there were people coming in, jobs were starting to get announced. And as we get up here and towards this point in between here, we probably had the apartments full, and now we need new construction. Well, we can't start building new construction until we can actually afford to. Developers aren't going to work for no money. So once those rents get to that point, we can start new construction. Here, rents are growing pretty strong. If you remember 15, 16, we had 5%, 6%, 8% growth, 10%, 12% in some markets. We're seeing that now, which is just stupid to me. In a lot of markets where you're getting 10% rent growth over certain periods, even though everybody's over here right now. But we'll talk about this in a minute. So your rents continue to grow. Your vacancy is staying low. Once we get here, we're starting to get some deliveries to the market. We've got more permits being pulled, more construction happening. So we're having deliveries and people still pulling permits, probably all the way to this point. We're still pulling permits. Although I got to say, we're at this point right now in a lot of markets and people are still pulling permits here. So from this point to this point, things start to stabilize. This is our equilibrium point, meaning that supply and demand is equal. Okay. When your demand for apartments is equal to the supply in the market, minus that long-term vacancy or occupancy average. So you always want to factor that in. We call that equilibrium. If you're not paying attention and you're continuing to build, you're continuing to pull permits, more product keeps hitting the market, right? So then we start to see the vacancies tick up. We probably still have a little bit of rent growth on this side, or right now, lots of rent growth, which again goes against conventional wisdom. But we've got some rent growth still occurring. Deliveries are still occurring, but vacancy starting to tick up a little bit because they're delivering a lot of units. Okay. And those units have to absorb to get that vacancy down again. Once we get down to this point, typically your market is no longer keeping up with the deliveries. The demand has slowed. Now your rent growth is starting to decline. Your vacancy is starting to increase, and that works you down to below that long-term vacancy average again. And now we're getting into a recessionary phase where you have rent decline, increasing vacancy, and you slide till you get to the bottom. So normally on a curve, and you'll see this on Dr. Muller's chart in a minute, we have a nice gradual recovery until we hit equilibrium. And then typically we have a pretty sharp fall, and then we go right back up again. So we've got nice long recoveries and real short oversupply and recessionary periods. It would almost show that for our chart right now, we've had this really long slope, and then COVID, and maybe a little tick down, but not much at all. We barely noticed anything in multifamily because the government propped us all up. So now we're just kind of trucking along like this on this bell curve. And then we'll start to come down. It'll come down pretty sharply. So I would argue that right now we're really just kind of trucking along at this point. And what you can really tell in a market is when you get a snapshot report, like from CoStar or somewhere like that, when your deliveries are occurring and your occupancy or your absorption is keeping up with your delivery. So absorption is end of year or end of period occupied units. We don't care about vacant units at this point for absorption. It is end of year occupied units minus beginning of year occupied units. So if we had 100,000 occupied units on December 31st, and we had 120,000 occupied units on January 1st, then we had a negative 20,000 absorption. If we had 100,000 on December 31st and only 80,000 on January 1st, that same year, so 12 months back, then we would have a positive 20,000 absorption. So really, why do we care about this? If right now the market is delivering 20,000 units a year, and you're absorbing anywhere from 80% or even greater than, there are markets where you're absorbing greater than the deliveries, that really shows a strong market. I think Austin is that way right now. There's a couple of other markets, Huntsville's that way, Pensacola's that way. So you've got these markets where you're delivering all these units and your absorption is either keeping up with those deliveries or it's even exceeding those deliveries. That is the sign of a strong market right now. That is no indication of what it's going to do in the future, but it's a strong market right now. So when all these gurus tell you, and was that me that just did that? Apparently it was. Hopefully you guys didn't see that. Whenever these gurus tell you, go back 20 years and look at a market and see what the population was. And now today, which you don't see today, you see 2019, see what the population is. And if there's been a 20% growth in population, that's a sign of an emerging market and you should invest in it. Anybody see any problem with that over what I've covered so far? Wait till I get into future demand and tell me if that makes any sense to you. Yes, we want to see trends. We want to know what it's done in the past. Really, I want to go back and see what it's done during recessionary periods and during growth periods. And we can do that with a certain type of analysis that we're not going to go into in this course. But there is a way where you can go check those different periods to see how a market responds to those certain situations. And then we can look for trends. That's why I'm looking in the past. Otherwise, I'm going to look at right now, where can I put it on this cycle chart and what it's going to do in the future. So if I've got a property or a market that is keeping up with delivery. So if we're delivering and we're keeping up with those deliveries and vacancy may be ticking up a little bit because of the deliveries, but we still have rent growth, we're keeping up with it. That tells me right now that we're more than likely well above this line and we're either here, here, or here. One of these three spots is where that market is going to sit, depending on where that rent growth is and where the vacancies are going. So if you continue to have rent growth and you got a little bit of tick up in vacancy, so you're keeping up with deliveries, but you're below it a little bit, then you're going to be on this side. But if you're exceeding your deliveries and your absorption and you're ticking up in rents, you're going to be on this side. Okay. So that's kind of how you plot it on that chart. I hope that makes sense for everybody. Any questions before I move on?
There's one in the chat. Wouldn't rent of new deliveries bring up average market rent?
No, demand and supply bring up market rents. So if I'm delivering and we have all these new units hitting the market, I could care less what the rents are for that market. Once those units fill up, that puts pressure on rents. Okay. So if there's, now you got to keep in mind with those new deliveries, you're not going to be able to get that unit unless you're willing to jump $200, $300, $400 a month. So you're probably going to stay where you are, or people coming into the market, maybe they can't afford those class A's. They're going to go look for a B or C to try to find a unit. So in a lot of cases, when you've got a strong market and there's people coming to the market and you have all these deliveries, that's why absorption will exceed deliveries, because they aren't just filling up the vacant units from the class A's, they're continuing to also fill up the value adds from the B's and C's. Okay. Did that answer your question, Lisa? Okay, awesome. Any others before we move on? All right, so this is Dr. Muller. He's at the University of Denver. He's a professor there. He puts this out every quarter. I need to update it because the fourth quarter is out. It came out a couple of weeks ago. You can see that at equilibrium, which is 0.11. Now notice his is more gradual. So his shows a little bit better. I drew that chart. If I go back, I drew this on a whiteboard called Limu and pasted it. I had fun drawing it and it looked good and I didn't want to erase it, even though I knew my bell curve should have been a little bit more like Dr. Muller's. So I just like the way it looked. But notice how we have this long recovery and then a little bit sharper of a decline. Okay, that's typical of most market cycles. There's nothing typical about the one we're in now. And you'll see that he has about 1/3 of the markets at equilibrium. And then he's got about, I don't know, half of the markets in 0.12 just beyond equilibrium. And then the remaining in 13 with San Jose sitting on the brink of going below that long-term average. Now I can tell you that San Jose has started to increase back up a little bit. They did probably drop down to 15. We've got a member in our mentoring group that I do a lot of one-on-one with her. Her and I have known each other for quite some time. We met in Toronto when I got pinned, and I help her with that market constantly. And I've learned a lot about the San Jose market. I grew up there, so I have interest there. But what happened during COVID was extremely interesting, and we were paying attention to that. So I'd argue San Jose made it to here. They're probably back to 13 now, and may even work their way back again, depending on how things continue to work out there. But I'd say they're probably about here right now. When you look at this chart, you'll see +1 and you'll see -1. +1 means that Palm Beach was in 0.11 last quarter, and they're at 0.12 this quarter. -1 means that Denver was at 0.3 last quarter, or 0.13. Now it's moved back to 0.12. So that's how you read this. We'll see Jacksonville, James, pay attention. Jacksonville was at 0.13 last quarter, and Dr. Muller has moved it all the way back to equilibrium. So that's how you read this chart. So you can see recovery, expansion, hypersupply, recession, how they all fit on the chart, which is the same of what I just explained in our bell curve. Okay. So let's have a little fun with this. So here's one I pulled off the internet from the stock market. And it's not much different than ours if you think about it. It's a little bit of a sharper because of all this volatility in the stock market than ours, but it's pretty much a bell curve just like ours is. So back in that bottom point, so say 09, 10, you know, you got a lot of people in disbelief. They lost their fortunes. They lost their retirement. There was a lot of disbelief going into the recovery coming out of the Great Recession. Then there was some hope. So, you know, we're climbing now. So we see this big spike and, ooh, we're hopeful. Okay. Keep in mind, we've lost all our money. We're not putting any money in yet. And then we continue and we keep going up, and it's volatile. It's going up, it's going down, it's going up, it's going down. And then we have this big spike and it's like, ooh, we got some optimism. Wow, look at this. And then it gets way up here and we start to get some drops and some spikes going down. And so now we believe, all right, this market's good. We're in a bull market. Let's invest. So now we get fully invested right here at belief. Okay, way up here. So now we're riding this thrill ride all the way up to euphoria, kind of like multifamily has been since about 2012, 2013, right? And then there's boom, we have these sharp declines. So all these corrections in the market, real sharp downs, huge volatility. And then it starts to come back up again. And as it's coming back up, we're getting complacent. Okay, we're working right back up to euphoria again. So we just need to cool off, let the next rally, and then it'll continue to go back up. But then boom, it starts to really go down. And all this volatility is happening, and you got this anxiety. It's like, oh, I got to do these margin calls. The dip is taking longer than we think. And then boom, we get into denial, and it comes all the way down and spikes up. And when it spikes up, we get into this denial mode where it says, okay, my investments are with great companies. They'll come back. But they don't come back. They go real sharp down. Panic sets in. You're like, oh, crap. Everyone's selling. I need to get out. I need to get out. And then capitulation sets in. I'm getting 100% out of the market. I can't afford to lose any more dollars. So we get out of the market here, but we got into the market here. I don't know about you guys, but you don't make money putting in at near the top of the market and selling at near the bottom of the market. Okay. Well, the market continues to go down. Now we're pissed off. We're angry. You know, this is taking forever and it's going along. Depression sets in. You divorce your wife, your dog dies, you wreck your truck, and then you start to come back again. And we're right back in that disbelief. Okay. This is a sucker's rally. All right. Not much different, just a lot more volatility and a lot more drama in the stock market than in our nice little pretty bell curve we have. But if you think about it, right now, multifamily is sitting about right here in between euphoria and complacency. Right now, everybody's making more money than they've ever made if they came in down here, right? Your foreclosure companies that built their multifamily companies down here, they are riding euphoria. Okay. And you've got a lot of new companies coming in, a lot of new syndication groups that are overpaying and do a lot of things that are probably sitting here. But a lot of people right now are being complacent about what's going on. Okay. Don't be that person. Be careful. We're sitting here. We're on the brink of all of this coming down and tumbling. Okay. I don't know when. I can't predict when. Nobody can. Not even your best economist can predict when. What I can tell you is I follow a Facebook group called Real Estate Mastermind. It is 165,000 residential brokers all over this country. And I pay attention to that group because I like to know what's going on in other markets with single family, just so I can pay attention to what it does. And what they're saying here lately is that inventory is increasing in a lot of markets. The time it takes to sell a property is taking longer. Price reductions are occurring. Multiple offers are stopping, and this is happening all over the country in the residential market. Typically, multifamily will lag behind what happens in residential. Pay attention. That's all I got to say about that. Rashid, where do we get the latest Muller cycle info? I will attempt to attach it to this at the end of the presentation. Just remind me. I have it in my my documents, and I can attach it here so you guys have it. Let's see. I think Sean sent. Let's see. Is the CCIM scholarship available? Yeah. Yes, Sean. The answer is yes on the scholarships. Okay, we answered that already.